Hello, everyone. This is Justin Smythe from nextbigtrade.com. This is the index review for January 3rd, 2025. The S&P 500 closed down just about 0.5% for the week this past week, which was a shortened week with the New Year's holiday right in the middle of the week. There's one more shortened week next week, and then full trading resumes the following week. Also, earnings season starts after next week, so really market activity should start to ramp back up after next week. So right now, the S&P 500 appears to remain in correction that started 3 weeks ago, and there's room for the S&P 500 to bounce here, which we'll look at in the breadth level. Short-term breadth is still very low. The S&P 500 put in a hammer candlestick to end the week last week with the bounce on Friday, and there's probably more room to bounce as we head into next week. But overall, unless things change with stage 2 breakout activity and volume, I think the S&P 500 is going to then roll over and continue to move lower into this correction. Looking at the daily chart, the S&P 500 was actually down 5 days in a row heading into Friday, where the market bounced pretty strongly, up over 1% for the week. Volume is still low with these holiday shortened weeks, but this will probably ramp back up again maybe next week or the week after, probably at the latest. So, the Santa Claus rally period is over. The market really didn't do great during this period overall. Obviously, there's some hot sectors that are still, at the tail end of their massive rallies at this point, but the overall market continues to behave weak, and a lot of stocks just aren't participating now, which starts to happen when corrections start. And again, the market probably has room to rally back up to these former resistance levels, but might just roll over again unless we start to see bigger volume come into the market. As I discussed in the newsletter as well, one of the things that tends to occur at the end of corrections in the major indices is you see some big buying pressure come in to end the correction. It doesn't always happen, but it happens probably more often than not. And we did see this kind of occur during the previous 2 corrections in 2024. There was some buying pressure that came in. Even after the small correction before the election, huge buying pressure came in right after the election. And right now, it just hasn't happened yet. We are transitioning out of the slower Santa Claus rally period, so we don't know exactly yet what the volume is going to be and if it's going to be, more buying pressure or not. But so far, all we have to base off of is the volume's not coming back in, which increases odds that this will just roll over into more of a correction. The equal weight S&P 500 obviously looks much weaker than the regular S&P 500 that's influenced by mega cap stocks. This actually had weaker volume on Friday, even though the market was rallying. It's still below all key moving averages, except for it's dancing on top of the 30-week. But if we get a breakdown here, obviously that's going to be bearish for the overall market. Still have a little bit of room to rally, but we'll see how we act against the 50-day moving average. Will be a key tell for the stock market, and we're below gap, the gap up from after the election, below that level with a lot of selling pressure overhead. So this is a key ETF to watch. The equal weight And again, there's just so many stocks that aren't participating now, starting in early December, which is, everything's concentrating in these hot sectors, and a lot of the market's just not participating now. Technology underperformed this week. It's holding up better technically than the rest of the market. It's above these key long-term moving averages, probably has room to bounce next week. And again, we'll see how the volume behaves if it does bounce. You can see it's above the critical election gap up still, and holding some areas as support. So nothing really looks terrible in large cap tech, but the S&P 500 is in much worse shape than the NASDAQ 100. NASDAQ Composite still in pretty good shape, above key long-term moving averages. Did have pretty good downside volume this week, but overall, looking better than the S&P 500. And then the Russell is basically right in this area where we discussed last week. There's the small caps have been fighting with this area for months and months and months now. Found it as resistance multiple times, finally broke out, then smashed back through the support, and now we're kind of sitting right there again. So whichever way this breaks will have a big impact on the market too. Did outperform this week, but has been underperforming, for many weeks, and finally had a bounce, while the S&P 500 was actually down. Now turning to breadth, this is where the market has more room to bounce. The percentage of stocks above the 20-day moving average still at the low end. If you look at what happened in 2023, this was able to get above 50% before some bigger pullbacks occurred in the S&P 500 during that correction. And then it would bring it back down to oversold levels at the bottoms of the move lower. So this is a main reason, there's more stocks that can kind of bounce here, push the indices back up before it rolls over again. And we'll see if that happens or continues to occur heading into next week off the Friday bounce. Percentage of stocks above the 50-day moving average. Another example of a bounce would be back in 2023. We got a little bit of a bounce back up to around 30%, and then the market rolled over again. So another breadth indicator that's at the low end, it could bounce here and perhaps roll back over if the market remains in correction. And then long-term breadth, we haven't really looked at this in a while, but I think this is something interesting to look at as we start 2025. We basically had a powerful market rally for over a year coming out of a massive correction in 2023. Lots of stocks participated. Breadth was solidly, 60% or so or more of stocks in the S&P 500 were in long-term uptrends, powering the market higher, creating a nice trending market for all of 2024, and the corrections were held within the 30-week moving average. They were not long and they were not big in magnitude. There was one 10% correction in August, and then there was the 5% correction in April, and that was really it. And a lot of stocks participated the whole time and remained in long-term uptrends. Now, there's been much more deterioration at the end of December. And if this correction brings this indicator down below 45%, that would mean that half the stocks are now actually in longer-term downtrends are starting to roll over, which the market could still break out of that and move back into a long-term uptrend, but it increases odds that a range-bound market could occur in 2025 because there's so many stocks that aren't participating. So keep an eye on where this behaves after this correction is over and what it does this year, if we get a bounce, but it kind of remains around the 50 to 40% level, that would lead to the idea that maybe 2025 could be much trickier, much more range bound than just a simple trend higher that we saw in 2024. So basically the idea here is just to recalibrate your mind, make it more open to possibilities that maybe 2025 is a trickier market with more range bound activity. And that's where you really want to take advantage of corrections. You want to buy when things are washed out, take the gains when the market moves back up, and then really exploit the corrections. That's how you make money in trickier environments than what we saw in 2024. So basically, just again, if less stocks are participating, the market's more difficult to trade, and we'll keep an eye on that as we head into 2025. The advanced decline line, probably something we'll continue to look at as well now that it's rolling over below this key moving average, the 10-week moving average. We'll see if it can move back above this or not. But again, another sign of a market that's not as strong as 2024 is a market that has more trouble around its 10-week moving average, just like 2023. And then we were in a downtrend in 2022 during the bear market. So we'll see how many stocks are advancing versus declining as we move forward into 2025. And then the VIX is still hovering right above the 10-week moving average here, kind of consolidating nicely sideways, after a big move when this correction started. So if this breaks out, then this correction is going to heat back up, and even trading volatility might be a good trade to profit off this correction. So bottom line, correction appears to still be in effect. More room to bounce over the short term for the S&P 500. And we need to see volume come back into this market to confirm the end of this correction, and that really hasn't happened quite yet.